Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. This is Daniel Lam, your host for the podcast. Desperate times call for desperate measures. Due to the war between Russia and Ukraine, European policymakers are facing big challenges. They face a trilemma of supporting consumption, taming inflation, and ideally preventing a surge in government debt. Clearly, it is very difficult to achieve all three, so this is really a balancing act. So let's start with the UK, which we discussed in our podcast on Tuesday. Overnight, the BOE announced they would be conducting QE in order to soothe the gilts markets. This is a 180 degrees U-turn on the QT that they were going to conduct starting the coming week. Now, this action calms the short-term market volatility in government bonds as well as the pound sterling, but really it doesn't solve the concerns about the long-term sustainability of UK's debt. Like we discussed this week, this fiscal stimulus is a very risky move that the UK government is making. If it works, it can stimulate growth, and also if the external environment improves, it can help them as well. Or it can also make future inflation path more uncertain and raises the likelihood that the BOE may need to do jumbo rate hikes in the future. Now, looking at continental Europe, the EU's emergency intervention is centered on obtaining excess profit estimated at around 140 billion euro per year from energy producers and distributing it to final energy consumers, both private and commercial, who are exposed to high energy prices. Germany also confirmed that the 2 nuclear plants will remain connected to the grid into next year in order to secure energy for the coming winter. It seems that the move by the EU is a bit more measured and appears to be more sustainable. The size of the stimulus is lower than the recovery fund and should not last beyond next year. The funds are intended to cover high energy expenses for consumers rather than supporting broad spending. If it works, then initial signs suggest that European inflation can also head lower. Government debts are not set to rise as a result of these policies because the funds are secured by effectively taxing energy company profits. Now, of course, there's clearly many challenges out there still for the European economy, but European equities is already projecting an earnings decline of 20%. Sentiment is already very poor and positioning very light. And so far the earnings have been resilient despite all that had happened. So we could be at an interesting juncture here for short-term tactical trade in European equities. Now let's take a look at the technicals of Euro Stoxx 50. The candlestick chart shows a hammer pattern at the lows yesterday with strong volume. So i.e. buyers are coming in size, pushing the index to finish at the day's high. This is usually a very strong indication of bargain hunters coming in, at least for the short term. So at the current level of 3335, we believe a short-term rebound to 3500 to 3600 is entirely possible. 2 areas to watch out for. One of them is European exporters, which can benefit from the weakness in euro, and also European financials, which can do well as we may rebound from extreme pessimism in business and consumer confidence. So that's all from me today. As always, if you enjoy this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details on the latest market insights, subscribe to Standard Chartered Money Insights.